Great. Hello there. Good evening. My name is David from RCM Online College. I'm here today with good news to inform you that RCM Online College is offering KNEC courses, whereby we are offering diploma courses in business management, diploma in investment management, diploma in human resource management. So to all of you who are out there, you are most welcome to join RCM Online College so that you can pursue your papers, which are being examined by Kenya National Examination Council. So today, I want us to look at this paper called Financial Management. Financial Management, which is being tested under 3 courses, that is Diploma in Business Management, Diploma in Investment Management, and a Diploma in Human Resource Management. So I would like us to start with this concept of payback period, which was tested in November 2022, question 3B, which was tested in November 2022, question 3B. So to have an introduction of what is payback period, to have an introduction of what is payback period. So payback period is a financial metric, used to calculate the amount of time required for an investment to generate enough cash flows to recover its initial cost. That is what is meant by payback period. That is what is meant by payback period. There is also another term which is called discounted payback period. There is a difference between payback period and discounted payback period. And what is that difference? So discounted payback period this time round, discounted payback period also calculates the amount of time, calculates the amount of time required for an investment to recover its initial cost. to recover its initial cost, to recover its initial cost, to recover its initial cost. But it takes into account, it takes into account the time value of money. But it takes into account the time value of money, That is the only difference between payback period and discounted payback period. Discounted payback period takes into account the time value of money, Great. So now, with that knowledge, or with that introduction, we can now look at this question of November 2022, question 3B, of this question, November 2022, question 3B. Now you can allow me to wrap this part so that now we can start looking at that question. Allow me to wrap this part so that we can start looking at that question. We can start looking at that question. Great. Now, let us read that question together. I will read. It says, or it reads, Nandes Limited intends to invest 4 million Kenya shillings in a project. The project is expected to generate the following net cash inflows. So we have year column, net cash inflows column, year 1, year 2, year 3, and year 4. Then we have the net cash inflows. Then we are told the company's cost of capital is 10%. The company's cost of capital is 10%. This is the rate of return. Then the company's policy is to accept a project with a maximum payback period of 2 years. The company's policy is to accept a project with a maximum payback period of 2 years. That means a project whose payback period is more than 2 years, even with a single month or a week. Any project whose payback period is more than 2 years, that project, according to the policy of this company, is not to accept that project. So now let us look at the solution. So we will come up with a table of columns. Whereby we will start with a column of year, cash inflows, and because the requirement is to calculate the discounted payback period. So because the requirement, let me read the requirement here. The requirement number 1, Roman 1, is to calculate the discounted payback period. Roman 2 is to advise the management on whether to invest in the project or not. So because the requirement by the examiner is to calculate the discounted payback period, we will have to introduce here a column of discounting factor. But first, let us have the cash inflows. So that we can see whether these cash inflows, are they regular or are they irregular, so that we can know the formula of discounting. So we normally start at year 0, because we are told The initial investment was 4 million. So we start at year 0, which is the initial outlay. We are told it's 4 million. 4 million, and this one will be a negative because it's an initial cash outflow. It will be a negative. It will be a negative. Then year 1, we are given a cash inflow of 1,500,000 positive. That is inflow. Year 2, we are given a cash inflow of 2 million, a cash inflow of 2 million, a cash inflow of 2 million. Year 3, we are given a cash inflow of 2,800,000, 2,800,000, 2,800,000, 2,800,000, 2,800,000. Then year 4, we are given a cash inflow of 1 million, a cash inflow of 1 million, a cash inflow of 1 million. So my good people, as you can see these cash inflows, how are they behaving? How are they behaving? You can see they are fluctuating. They are dancing. They are dancing. These cash flows are not the same. You can see year 1, it's 1,500,000. Year 2, 2 million. Year 3, 2,800,000. Year 4, 1 million. So they are fluctuating. They are fluctuating. So which method of discounting are we going to use here? So my good friends, the method of discounting which we shall going to use here is called PV, is called present value interest factor. This formula of discounting is for irregular cash flows, is for irregular cash flows, is for irregular cash flows. So present value interest factor, this means in PV, in short form, this is present value interest factor, present value interest factor, present value interest factor, present value interest factor. And what is the formula of PV? The formula of PV is given by 1 plus R into bracket raised to negative n, whereby R is the rate of return, the cost of capital. R is the cost of capital. R is the cost of capital. R is the cost of capital. And what is the other formula? What is the other formula of discounting? What is the other formula of discounting? The other formula of discounting is called PVFA. PVFA is called PVFA. PVFA, and this means present value interest factor, present value interest factor, present value interest factor of an annuity, present value interest factor of an annuity, PVFA. PVFA, present value interest factor of an annuity. This formula of discounting called PVFA is used to discount regular cash flows, uniform cash flows, uniform cash flows, uniform cash flows, uniform cash flows, also known as annuities, also known as annuities. And what is the formula of getting PVFA? It's 1 minus the smaller formula of PV. So it will be 1 minus into bracket 1 plus R raised to negative n divide by R, divide by all over R. So this is the formula of getting PVFA. But in our question, we have said these cash inflows are fluctuating. So we shall use PVF. We shall discount these cash inflows using PVF. So let's have our PVF column here. And the formula is 1 plus R raised to negative n, 1 plus R raised to negative n, 1 plus R raised to negative n, 1 plus R raised to negative n. Let me wrap this part so that we can have our workings here. 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 So for year 0, that will be PV, which is equals to 1 plus R raised to negative n. So when you take 1 plus the rate of return, The cost, we have been given the cost of capital. Cost of capital, we have been given the cost of capital as 10%. The cost of capital we have been given as 10% from the question. So that this is our rate of return. So this is our R. So it will be 0.1. It will be 0.1 raised to negative n. N is the number of years. So at year 0, it will be minus 0. It will be minus 0. It will be minus 0. So when you take your calculator, this will be 1.1 raised to negative 0. 1.1 raised to negative 0. What are you getting? 1.1, you raise to negative 0. You are getting 1. 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 What about the second for year 1? What about for year 1? What about for year 1? It will be 1.1 raised to negative 1. 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 So we are getting a figure of 0.9091. It is always good to have your discounting factors to 4 decimal places, to 4 decimal places, to 4 decimal places, to 4 decimal places, to 4 decimal places. So we're getting 0.9091 for year 1. What about for year 2? What about for year 2? It will be 1.1 raised to negative 2, raised to negative 2. So with your calculator, what are we getting? 1.1 raised to negative 2. 1.1 raised to negative 2. It will be 0.8264. It will be 0.8264. 0.8264. 0.8264. What about for year 3? It will be 1.1 raised to negative 3. 1.1 raised to negative 3. 1.1 raised to negative 3. What are we getting? 0.7513. 0.7513. 0.7513. 0.7513. What about for year 4? It will be 1.1 raised to negative 4. 1.1 raised to negative 4. 1.1 raised to negative 4, which we are getting at as 0.6830. 0.6830. 0.6830. 0.6830. So what is the next step? The next step is to get our discounted cash flows. The next step is to get our discounted cash flows, which in other words is called present value. So discounted cash flows, discounted cash flows into bracket present values, present value. So we are getting our discounted cash flows by taking the cash inflow times the discounting factor. So my good people, let us do the multiplication here. So the first one is minus 4 million times 1. So the first figure is minus 4 million. The first figure is minus 4 million. What about the second figure? It will be 1,500,000. 1,500,000 times 0.9091 times 0.9091. We are getting a figure of 650. What about year 2? We will take 2 million times 0.8264. What are we getting? We are getting 1,652,800. What about year 3? We are just multiplying here. What about year 3? You will take 2,800,000 times 0.6830. 0.6830. What are you getting? 1,912,400. And what about the last year, which is year 4? You will take 1 million times 0.6830. What are you getting? What are you getting there? 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 We are getting 683,000. 683. 683,000. 683,000. 683,000. Now the examiner is requiring us to calculate the discounted payback period. So we will have to introduce a cumulative cash flows column. Cumulative cash flows column. Cumulative cash flow column. So let us write here cumulative cash flows. Cumulative cash flows. Let us write cumulative cash flows. So what is our first figure? What is our first figure? Our first figure will be minus 4 million. Minus 4 million. Minus 4 million. This is how you are to get the cumulative cash flow. You start with the first figure. You start with the first figure. You start with the first figure. Then you add the first figure to the second figure, to the second figure, to the second figure, to the second figure, to the second figure. It will be minus 4 million plus 1,363,650. So what are we getting? We are getting minus 350, but it is a negative. It is a negative. And what is the cumulative figure for year 2? Year 2. We will take the cumulative figure of year 1, we add with this figure of year 2, the discounted cash flow figure of year 2, which will be minus 2,636,350. We add 1,652,800. What are we getting? We are getting minus 550, but it is a negative. It is a negative. What about the cumulative figure for year 3? It will be minus 983,550 plus the figure for year 3, which is 1,912,400. So we are getting a positive figure this round of 850. And what is the cumulative figure? What is the cumulative figure for the last year? For the last year, it will be 928 plus 683,000. So we are getting 1 million. We are getting 611,850. 850. Great. Now, when we reach at this point, we are supposed to get or to determine the number of years the investor will be able to recover its initial cost. So from this table, how are we supposed to get the payback period? How are we supposed to get the payback period? PBP, payback period. How are we supposed to get the payback period? So you will come here to your cumulative cash flows column. Then you go up to the last negative figure, which is 983,550. This is the last negative figure. After this, now we are starting to get a positive figure. So the last or the least negative figure, which is 983,550, you will read the years. You will read the years from this part. So how to get payback period? You will read the year for the last negative figure, which is 2 years. we are supposed to add, add the last figure. We are supposed to add the last negative figure, we are supposed to add the last negative figure. But because the last negative figure is a negative, we need to cancel. We need to cancel that negative. We need to cancel that negative because we cannot put a negative here. We need to cancel that negative by introducing a negative sign here, Then now we put the last figure, the last negative figure, which is minus 983,550. So here a negative and a negative will give us a positive, the way we wanted it to be, Then we divide this last negative figure, which is negative 983, we divide it by the next cash inflow figure, the preceding, the next figure, which is 2,800,000 cash inflow, 2,800,000. So our payback period will be equals to 2 minus. Can we take minus 983,550, we divide by 2,800,000. What are we getting? We are getting minus 0.35. That is to two decimal places. Minus 0.35. So our payback period will be equals to, minus and minus will be positive. Minus and minus will give us a positive sign. So it will be 2 plus 0.35. So our payback period will be 2.35 years. And that is how you should have done that question. That is how you should have solved that question of November 2022, question 3B Roman 1. 3B Roman 1. Now let us look at Roman 2. Roman 2 of the same question, we are told to give an advice, to advise the management on whether to invest in the project or not. But let us remember the condition which we have been given there. We have been told the company's policy is to accept a project with a maximum payback period of 2 years. There was a condition given there that the company will accept any project, provided the payback period is 2 years and below. 2 years and below, not 2 years and above. 2 years and above. So when we look at our payback period, for this investment, it's 2 years and some months, 2.35 years. That means it's beyond 2 years. It's beyond the maximum of 2 years. Therefore, what is our advice to this company according to their policy? So Roman 2, let us write the advice here. Let us put the advice here. The advice here. This is Roman 2. Question. Now, November 2022, question 3B, Roman 2. So we will advise the management by telling them that because the payback period of this project is more than the maximum you required, then you need to reject. So the management, this is our advice. The management should not accept the project, because the payback period, because it's payback period, because it's payback period, because it's payback period, its payback, because its payback period is more than 2 years, 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 which is against the company's policy, which is against the company's policy, which is against the company's policy, which requires the company, which requires the company to accept a project, which requires the company to accept a project with a maximum payback period, of 2 years, And that is the end, of our question. That is the end of our question for today. So remember, you have been receiving this class. You have been enjoying this class from RCM Online College. As I have said, we are offering KNEC diploma courses. We are offering KNEC diploma courses whereby you can study at your convenience time. You can study at your convenience time. We have live classes. And on top of that, you will get a recorded video of the live class. In fact, I have been recording this class. So after this class, this live class, I will be sending that same video to you guys for your revision, and to watch the video very slowly, and in which area you have not understood, you will be able to get it right, So we are charging a favorable rate of 1,000 per unit, 1,000 per unit. And our contact number is 0719 52 5000. Our contact number, let me write it down here. Our contact number is 0719 52 5000. Our contact number is 0719 52 5000. You are most welcome to join us and enjoy these great services, Enjoy these great services. Thank you very much. See you another time. Bye bye.